from what I can tell, you can't really see me that well, can you? So let's just make some of this brighter. Now, grab a pen and paper. Please also turn off your TVs, because we're talking about making money, and I think that's important enough that you should concentrate. So, and you'll need a cell phone to take photos of some of the screens, because I'm going to be covering a heck of a lot of information. Okay, so you should be able to see the screen, you should be able to hear me loud and clear, as they say, as well. And I'm going to keep an eye on the chat. Teesside Graham as well. John, Neil, Richard, welcome one and all. Most of you are in the UK, which is nice, but I know there'll be quite a few from the United States. Graham, Aditya, two Johns, Michael, David. Welcome one and all. So let me get on with this. How do we profit from volatile markets? And as you've seen, the markets have been incredibly volatile. The things we are going to be focusing on in this webinar are these, okay? You can see here on the left-hand side, there's a heck of a lot of instruments I could have picked, and I can't go through every single one. So I've selected 1, 2, 3, 4, 5, 15 of the ones that we're going to concentrate on in this webinar. I'm going to discuss a business plan for you, whether you're a beginner or advanced. I'm going to give you the best trading insights from the world's leading traders. You should be able to see me holding up my book now, Mind of a Trader, Lessons in Trading Strategies from the World's Leading Traders. You're going to be able to get a free copy of that. I'll give you the link in, I think, 2 slides time, so you can download a free copy of that, which was my interviews. It's a book published by the Financial Times, as I said. It's a book with my interviews with some of the world's leading traders like Bill Lipschutz, Global Head of Foreign Exchange Trading at Salomon Brothers, so the world's largest Forex trader. They're the people who taught me how to trade. They're the people who, after a number of years of mentoring and following their advice, I was able to set up my own hedge fund in 2004. Okay, but as with writing that book and the other books and my TV show on Bloomberg and my column in the Financial Times, I've continued teaching private investors. This is the book Trading Online, and I'm going to give you all the contents of these books in this webinar, so it's going to save you a hell of a lot of time reading. And as I said, those are the instruments we're going to focus on. So a lot to cover. You'll need a pen and paper and a cell phone with which to take photos of some of the slides. So getting on with that, let's move to the first slide. Quick disclaimer, I don't know you personally, and therefore this is not individual financial advice, because I don't know who you are personally. Okay, like I said, put into the chat box that where you're from, and well, whether you're a novice, it's the first time on one of mine or not. Now, I already told you about the books. I like everybody on my webinars to be over the moon and happy with what I'm providing. So have a look at alpeshpatel.com/links. You're able to download free copy of Mind of a Trader, Lessons in Trading Strategy, okay, from the world's leading traders. And follow me on LinkedIn, where you'll see my latest articles and columns and all the rest of it. So that's a little bit of a bribe, a free bribe, because I want you to love it. One of the reasons why I do what I'm doing in these webinars is it's part of my campaign to teach 1 million people how to be better at investing and know the financial markets, because the financial markets control your mortgage and your pension, as you may well know. Just put that down. And therefore, I want to make sure people are aware of it. And as I say, my journey for the last 25, 26 odd years of communicating with people through TV and everything else. I was supposed to be on GB News Nigel Farage tonight talking about pensions, but I had this commitment, so I've done the webinar instead. As I've mentioned before, my reasons for doing this and my reasons for making sure you do it is this: trading is the best entrepreneurial side gig in the world, because you don't have warehouse costs, supply chain costs, employees, you don't have overheads, you don't have cash outflows. Therefore, it is a good entrepreneurial side gig. Also, unlike normal businesses where 90% fail within 3 years, 30% of private investors, you'll see in a second, actually make money. That does mean 70% lose money. So how do we make sure we're not one of the losers? And that's my job, to teach you that. It's what I've learned through all those books and applying it myself. So I want to make sure, going from professionals such as myself to private investors such as you, you learn best practice. And that's what this webinar is going to teach you. It's going to teach you how to do it better, what not to do, and then give you the strategy that I use. We have 10 strategies in the hedge fund. The very first one is the one I'm going to show you, which is trend following and momentum, which is because it's the easiest one. It's the one I was taught as a student by Bill Lipschutz, Global Head of Foreign Exchange Trading at Salomons. And if you think, well, why are you giving the secret sauce? Well, it's not my secret sauce, and it doesn't harm me by you knowing how to trend follow. Okay, well, if it does harm me, please let me know how, unless George Soros is watching this. Okay. we've also got to make sure it gives you enough freedom. So the trading strategy is going to be such that you're not having to be in front of the computer all the time. Otherwise, what's the point? I wrote a column in the Financial Times many moons ago where I said that if you're going to be in front of the screen as much as most people are, with the amount of capital that they have, they might as well get a job at McDonald's because their hourly rate's too low. So we need to either increase your capital, which I can't magically do by wiring money in your bank account, or reduce the amount of time you're in front of the computer screen so you get a better return on your hourly rate. So we've got to make sure you get that freedom, we make sure it's fulfilling and it's fun. But most importantly at the moment, make sure it generates enough funds. And the way we're going to do that, these are going to be some of the important numbers. And you might want to take a note of some of these numbers, okay? These are incredibly important numbers and that we're going to work across. We're going to work across these numbers tonight, which are we're going to look to scan the markets for 15 minutes a day or 1 hour, say on a Monday. 15 minutes a day, scan these instruments you see. Ideally, I want it to be 12 to 24 instruments, a good diverse range, everything from currencies to indices to individual stocks, so that they're not all highly correlated, so you get different opportunities to be long on some, short on the others. So we're going to pick one quality trade a day, and I'm going to show you the business plan why I don't want you initially doing more than one a day, and that'll be ample money for you. And the reason I don't want you doing more is because I don't want you trading out of boredom or trading out of frustration. A lot of people, they spend so much time in front of the computer that they'll start doing low quality trades out of boredom, and I've seen it often enough. And if you want to deep dive into that and evidence of it, well, when you download and read the book for free, as I said, through the link I gave you a moment ago, you'll find out there's ample evidence for that. And I've also published it in my other books as well. And when I was a visiting fellow at Oxford University lecturing on behavioral finance, I've done it there as well. Okay, so there's a lot of evidence to support. We don't want you spending too much time in front of the computer screen because you'll just trade out of boredom. And that means lower quality trades. It's about quality over quantity. I gave a TEDx talk about 2 weeks ago where I surprised the audience by saying that the thing that I found, and it was a TEDx talk on what I'm presenting to you now, the thing that I found that surprised me the most about hedge fund managers is just how long they just wait and wait for the right trade. In other words, how they're implicitly risk averse. And I really want you to be scared about trading, not just risk loving and thinking, oh, just, gung ho, it's so easy, shortcut to riches. No, it's not. I want you to be scared of trading so that you wait and wait and wait till you get a good quality trade in a day. Then you place that instead. And you can do that when you scan for 15 minutes, because if you've got enough instruments you're looking at, one of those will start showing a trend. Okay, and that's the shortcut way to do it. You just increase the number of instruments you're looking at. That allows you to reduce the amount of time you need to look. Because if you had one instrument, you'd have to look all day to find a trend. If you've got 15 to 20, you can reduce the amount of time. That typically means we're going to do 20 trades per month, and I'll show you the business plan where that will make you ample. What is ample? Well, the problem we've got to overcome that is that people don't have enough time. Well, we're going to overcome that because I'm going to give you the process where you're looking at just 15 minutes a day scanning the market. They don't have enough money. Well, like I said, we can either increase the capital you've got, which I can't magically do, or we reduce the amount of time in front of the screen. You build up the profits slowly, and then you reinvest those profits into ever larger trades. You don't use capital to increase your trading size. You use the profits that you gradually make. So it is, I'm afraid, a very slow process in that regard. So if you're looking for a get rich quick, please leave now. But if you're looking for, oh no, I'll just make a little bit every day, every week, and as I build up the pot, that's the pot I'll risk to make more and more and more, and ever larger trading sizes, and it compounds. It compounds without risking your initial capital. In fact, we're going to start with a demo account to begin with, because why risk real money at all? And then I'm going to give you this good, simple strategy, 1 out of 10 that we used on the fund. That'll make your life easier. The sums we're going to be targeting are these: 500 to 1,000 a month. Why 500 to 1,000? Well, when we asked people how much, we did a survey, how much do you think should be your target income? We were pleased to see the vast majority said 500 to 1,000 a month, because I think people implicitly understand that the difference between rich and poor is not millions a month, some kind of magic number, where, when most people are going to open an account with maybe, I don't know, $1,000 or 2,000 or even 10,000, but nothing magically large. They know that the difference between paying off a little bit more of their mortgage or their electricity bills or their rent or their kids' education is maybe 500 to 1,000 a month extra. Okay, or paying down credit card debt. It is not trying to be greedy, because trying to make more would imply greater risk to capital. and we want to mitigate risk. Now, I'm going to sound really boring and dull like your dad on this. I could say like your mum, but I'm not female. So like your dad on this, which is we're going to be, like I said, risk averse. Now, why should I be so risk averse? It's not my idea. It's what I learned from the world's leading traders. So what we're going to do is build it up slowly, and we're going to go for smaller initial sums, because also psychologically it's easier to do. Now, I know you've seen images like this, profit recorded by top spreadex trader, £1 million. I don't know spreadex. I don't have any connection to them. This is not an endorsement of them. This is an image I found many years ago when I was writing a book on what is it that private investors do who are making money, which is different to the ones who are losing money. So we got blind data from a bunch of brokers and then put that data into a book and try to correlate what were winners doing over losers and what are the things that they were doing which professionals do as well. And we were looking for an edge, actually. We wanted to get a lot of big data. When you say you're writing a book, you get big data from brokers. People want to help you. So we published that book, and I'll share the findings with you along the course of this webinar. So we wanted to know, do men make better traders than women? No, by the way. Are longs better than shorts? No. Are there certain products which are easier to trade? Yes. And I'll tell you some of those in a second. Were there certain times of the day where it was better? Could you work out that if you were likely to hold a position for beyond a certain period of time, you're more likely to have a loss than if you held it for a shorter period of time? Yes. And then when we discovered those little things, we were able to know, oh, actually, now we should tweak things down. And that's what we've done with what I'm going to show you in all of this. Okay, I'm going to put a little survey up. I'm going to put some surveys up as we go throughout this webinar so that you can see things as we progress. Okay, so have a look at that survey. So that's where that came from. I'm going to show you some charts in a second as well. And these are some of the important points we're going to cover. It doesn't matter what you buy and sell. I get people obsessed with, oh, I want to trade stocks. Why? What is wrong with you? Why just one group of securities which are highly correlated to each other? I don't care whether I'm making money in stocks, currencies, whatever it is. I don't like paying subscriptions for anything. A, because I'm money conscious, but also because when you're paying subscriptions for something, there's usually a conflict of interest with the other party who want to, let's say they're saying to you, oh, use our software, and they're like, yeah, well, do they have a vested interest to make you money? Because they really need you to keep the subscriptions going. It's like being on a drip. Okay, avoid any service that's tied to a specific broker. If somebody says use our broker, then ask them, are you getting a kickback? Because they legally have to tell you. They can't be a hidden agent. And if they are getting a kickback, then they need that broker to make you lose money. So they get a percentage of those losses. They get a percentage of the losses. Brokers are not estate agents anymore. Brokers are casinos now. In other words, they're the house. They get a share of the losses that you make. Okay, they're not estate agents, which is what people think they are. Where, oh, the broker charges me commissions. I just get it's just I'm just sharing the commission with someone. No. They get a share of the profits. Okay, so there's a huge conflict of interest when somebody is trying to push you to certain brokers. And we'll talk about brokers at the end in the Q&A. References have to come from industry leaders. Do not listen to a reference from Mrs. KL from Croydon, Mr. JM from Manchester. Okay, it's got to be industry leaders speaking about that. And I guarantee you, they will never find an industry leader of any repute. And don't fall for the, oh, look, we got award as best this or best that. Yeah, if you advertise in a newspaper or an event company, they'll give you a bloody award. All right, so don't fall for that crap. We've got an award. Teachers should be the world's leading traders. My teachers are the world's leading traders. My teachers, I put into a book. Okay, so I've got proof they're my teachers because when I met them, I decided to put the interviews in a book and the Financial Times published it. If your standards are lower than that, you're out to lose money. Okay, now what I find with retail clients, which really annoys me, is how risk-loving they are. They're just crazy when it comes to risk. They just love taking shed loads of risks. I don't know what's wrong with them, but they just love taking shed loads of risk. Now, when it comes to trading, you've just got two things to do. You need to know when to buy, when to sell. That's it. So how come when you look at this down here, you see all these taken from 3 different stockbrokers? I think it was IG, Saxo, and CMC. How come the vast majority of their clients are losing money? Yeah, as you can see, look, 66% lose money there with that broker, 66 with this, and 61 with that. I don't know which one's IG, which one's CMC, which one's Saxo, but anyway, that's how many lose money. Well, you only got 2 decisions to make, when to buy and sell. Surely that should be easy enough. It should be 50-50. Well, partly it's the broker screwing you. It's partly your own fault because you don't know what you're doing. So my job is to put you into the 39 to 34% while making money. And that's a pretty wide goal. That should be pretty straightforward. After all the name dropping and bragging I've already done, I should be able to do that. And the way we're going to do it is we're going to pick something relatively straightforward and simple, which is following trends. We're not going to try and outsmart the market. I cannot possibly try and outsmart which way sterling's going to go against the US dollar. By the way, anytime you see a green arrow, that means to go long. And I'll explain how we got that entry. Red meant to go short. That didn't work. If you looked at that screen, you'd say, oh, come on, Alpesh, you're only right 50% of the time. You'll know better than the coin. And I'd say, yeah, the red trade didn't cost anything. I mean, it broke even. Could even say it was a small loss. The green trade made a hell of a lot more money. That's what trading is. Even if you're right 50% of the time, your wins should be making more money than your losses. Those people who say, oh, we've got some secret sauce which allows us to be right 80% of the time, 90% of the time, 100% of the time, they're idiots. And the people who ask, oh, are you right that often? They're idiots. And I'll tell you why. A coin, and I want you to do this experiment tonight, toss a coin 100 times. You may well get a winning streak of 7 times out of 10. You toss heads. Does that mean you're going to start a business as the world's greatest coin tosser because you were right 7 times? You might even get 10 heads in a row if you toss it 100 times. You might. It's improbable, but you might. There's a difference between a winning streak and what the average is. And people will happily promote any winning streak, or they'll just lie. What matters is, there, look, all I've shown you is I'm right 50% of the time, wrong 50% of the time. My 50% right make more money than the 50% wrong. Actually, we're a bit better than 50-50 because we're as good as a coin. We'd just literally use a coin then, wouldn't we? Okay, we're a little tiny bit better than a coin. Not much, but a tiny bit better. And that's all it takes. And that's what we're going to focus on in today when it comes to the strategy. I'm also going to teach you, where do the stop losses go? SL means stop loss. Where do we add to our winners? Winners add to winners, losers add to losers. So I'm going to teach you the basics of the strategy, which makes life easier for you. By the way, for those interested, that's the FTSE at the moment. If you watched yesterday's webinar, you'll know that we were short and continues to be so there. Now, you can see 3 trades there. That was a short, which nothing came of it, did it? Yeah, you can see nothing came of that. Then there was a long and nothing came of that. Then there was a short, which bloody hell made up for everything, and then some. So there we were right 33% of the time, 1 in 3. But the size of the win there, especially because we add to our winning position, so we're short sell there. We haven't closed this yet. We haven't bought it back. That dotted line is where, and I'll explain how you work these out yourself, is where we add to that winning position. We take some of the profits we made by the time the price got there. We had some profits, and we risk those by opening another position in the same direction. Okay, so we risk profits. We don't like risking capital. We like risking profits, not capital. Capital's precious. Profits, yeah, less so psychologically and in real terms. So that shows you what the real world of trading is, not the bullshit. Oh, look how we were right here, we were right there, we're right there. And here's a few other confessions for you. Notice how when going short there, we didn't pick the top of the market. We didn't get there. We don't have some secret voodoo Elliott wave Fibonacci nonsense, which will help us get right at the top of the market and right at the bottom. And people drawing all those wonderful little lines and showing you how accurate their voodoo is, they're lying to you. Okay, I can tell you both as a retail investor and as a professional, they're lying to you. And I can tell you as somebody who's published enough literature which has been reviewed by the leading authorities, including the world's leading traders, and I'll share some of the comments they've made on the strategies that I've shared, that I'm right, and people telling you that they can get to tops and bottoms are wrong. And I'll also show you slides from one of the largest hedge funds in Europe in a second on that. So that's where we are on the FTSE, and it's still short as things stand. Let's go to the S&P 500 for a second, and that's where we are on that. Now, there was a short, which snapped back there. There was a long, which did well. Great. Thank you for the profits. There was a short, which did incredibly well. Actually, initially went against us, but not much, and then collapsed. That was great. So win-win, call that evens. Okay, and we're in profit on that one. That tells you something else about trading. If you've got a process, it avoids the psychological problems of 1 minute being short, the next minute being long, the next minute being short, the next being long. Now I'm showing you this. These are live prices. You can see them moving. Okay. By the way, all this data is live, real time, and free. I've commented on it in my Financial Times columns. I hate subscriptions. Whenever I can, trying to give people free information. This is just, it's called MT4. M for Mike, T for Tiara, and 4, well, Tango, and 4, the number 4. Okay, and it's free. It's broker independent, which is what I like. It's broker independent, and I don't have any commercial relationship with them. Well, it's free anyway, so what relationship could I have? But the point is, if you get things for free and live and real-time data, great. Okay, the point again also being with this is, yeah, psychologically, I am not invested in whether the S&P goes up or down. Psychologically, I need to be carefree. Not, oh my God, what's it going to do? Please go up, please go down. I also need, therefore, an independent process, okay, a checklist. And that's what this process gives you. So we'll talk about where do we put the stop loss? Where do we add to winners? How do we know when to enter? We're going to cover all of that. And we'll come to Royal Dutch Shell and all of these other ones in a moment. I just want to get back to more of the slides right now. Everyone happy so far? Let me know. Let me know, okay? Graham, is that right? Can you send me an image of that? If you can, and which broker are you talking about? Do let me know, because that'll be good to update. That'll be fantastic to update. Will the FTSE end up the year higher? 60% believe so. You're a wonderful optimist. I've just closed that poll, so the majority of you thought so. And how about the Dow? Another poll that's going to go up. If you can't see it on screen, don't worry. Okay, so moving across really speedily. I know I'm speaking really quickly. That's your typical data. This is an old screenshot. Sterling US dollar. Okay, that's your typical data. Your job, mine is, most of you are probably going to be like trader one. Okay, you're probably going to make 500, not because you've done anything wrong. You, me, George Soros see the same data. You place that trade, then you place that one, and you made the money. You might make £500, and you'll kick yourself that you didn't make 5,000. The only difference between you and somebody making 5,000 should be not access to data, not inability to see a trend. It should simply be the amount of capital you've got. That's why that person made 5,000. And trader three, so that was what I love about trading, is it's the great democracy, the equalizer, the meritocracy. The only thing that differs is the amount of capital you've got. You might say, well, that's a big bloody difference, Alpesh. Well, until the government start dishing out free capital just for traders, that's a different problem. But look, 500, 5,000, 5 million, you got the same data, you've got a level playing field. You've got to decide when to buy and sell. The only difference should be the amount of capital you've got. I know it's a big difference, but what I'm saying is the difference isn't they've got some secret information. The difference isn't they've got secret prices. The difference isn't they've got a secret broker who gets them in at a cheaper price than they get you. Well, fractionally maybe, but it's not going to be magnificently different. It's not going to be much different, okay? The difference should be, okay, when do you buy, when do you sell? That's it, knowing the entry and the capital. Now I'm going to teach you the entry of a trend and the exit. So you're going to have the same skills that the great and the good have, because I'm going to teach you what I was taught from the world's leading traders. Nothing I tell you today has been invented by me. Not a single sausage. I'm not Isaac Newton. I'm not a genius. I'm just copying what the best people did. It's a bit like a tennis player saying, listen, I didn't invent the game. I'm not a great player, but I'm going to teach you what I learned, and that made me a great player. Okay, I didn't invent how to be great at it. I just copied what Federer did, for instance. That's my approach to things. It's trend following. Okay, brokers I'm going to do in the Q&A. We're going to do a structured approach. So as I said earlier, I'll discuss brokers in the Q&A and which ones I like, which ones I don't, which ones are regulated, and so on. Okay, now, like I said before, and sooner or later, somebody in this chat box is going to say, can you do stocks? Yes, you can do stocks. But like I said, I want you to have a diverse range to select from. That means a lack of correlation between instruments. If you've got 24 stocks you're looking at, guess what? They're usually highly correlated, especially when the markets fall. So I want you to be looking at different currencies, different indices, different individual stocks in different sectors and different geographies. So I've got Shell. Okay, let's have a look at Shell. So where we are with Shell. If you watched the webinar yesterday, you know this is the position we've got on Shell, and it continues being so. And thank you very much for those who were on yesterday, because we've done rather well out of that position in Shell. And I hope you guys this evening will be an equally good audience in terms of lucrativeness. And that's JP Morgan. Banking, different, completely different sector, but we should look at not just those two, but as I said earlier, we're also looking at currencies. Now, of course, there's still some correlation between all those three things, but it allows me to pick one trade with a good trend, which isn't just a variation on the previous one. So I don't just want to look at stocks, and I've got a hell of a lot of instruments. I don't know, about 6,000 blooming instruments or something, especially when you multiply across the 3 time frames that I like to trade on. And write this down: 15 minute, 30 minute, 1 hour. Now, those 3 time frames You don't need to be full-time in front of your screen to monitor those. As I'll show you earlier, the trends tend to last at least a day on the 15-minute ones, okay, and several days on the 1 hour. Therefore, you can just scan the market, you can place your stop loss, trailing stop loss, and go to work if you wish, okay? If you're, of course, in front of the computer, then you can do a more nuanced trade and decide when you want to exit part of your position or all of it. But what I'm saying is you can be a day jobber and you don't have to be a day trader, okay? And that's what we're looking at. So that was the last, as I was asked by somebody, how accurate is this whole trend following palaver? And I said, well, let's just have a look at the last month of 2022 in the S&P 500. It was not a typical month, because actually it was quite good. Not quite good because we could move the market, quite good because there were some long trends, which, yeah, we captured, but if those trends didn't exist, we couldn't have captured it. Okay, so we were lucky. We were lucky because those trends came about. That's the whole point of the markets. We put ourselves in a position to be lucky because we're trend following. So we were in a position to take advantage of that opportunity. But the luck element comes from the fact that there were some big trends. And there were some trades which didn't work out. I mean, the first 3 days were the first 3 trades were rubbish. 1, 2, 3 were rubbish. And then, oh, thank you very much. And then another rubbish one. And then, oh, yes, thank you very much. Thank you very much. Thank you very much. Thank you very much. This is not typical. Typical could have been the exact inverse of that. Okay, the whole point is I can't dictate what the market will give me. I've got to take what the market gives me. All I can do is be in a position to make myself lucky by looking for those trends. As I said, how we do that, I'm going to show you on the strategy part, and whether it's worth it or not, we'll do on the business plans part, which we're about to start in just a second. So similarly with big oil drops, we want to capture those, and that's what trend following is about. I didn't know oil was going to fall. I didn't have a bunch of analysts over my shoulder like a Goldman Sachs. Couldn't afford it. We are riding the coattails of a market move. Do you understand? Because if you're a retail client, that's the best you can do. You are not going to outsmart the market. Okay, I can't. And the biggest hedge funds in the world trend follow as well. AHL, Winton, Aspect, they're all trend followers. The owner of Liverpool Football Club, John Henry, trend following hedge fund manager. Okay, so that's what they do. Look at that. That didn't work out. That was okay, but this one didn't. And yet, boom. Okay, this one didn't work out. Did nothing. But that's what makes up for it. And I want you to write something else down. 80% of your profits in a given year will come from 20% of your trades. Now, you've got to appreciate that. It's the same for every single professional trader and hedge fund manager. 80% of your profits will come from 20% of your trades. Alpesh, I want 100% of my trades to come from 100% of my profits. No, it's not going to happen. I wish I want to be right 100% of the time, or 90 will do, thanks very much, or even 80% will be do. Anybody who tells you that is lying, okay, or they're delusional. It's not going to happen. 80% of your profits will come from 20% of your trades, and I'm going to show you the mathematics and deconstruct exactly how. Now, there's another important point I want you to make. Your final destination, and we're going to do a business plan, but just to whet your appetite, your final destination is going to be $10 a point. Whether you're doing spread betting, CFDs, futures, options, cash, doesn't matter. Everything can be translated in how many dollars you make per point or pounds you make per point. That's your final destination. Now, for some, it might be a year, 2 years, 3 years. For some, it might take 10 years. You're not going to have the money today to do that. That's what ultra high net worths do. And you might think, nah, don't be daft. Yeah, I've got a lot of friends who are ultra high net worths. I'm not talking institutions. We're talking ultra high net worths. They do about 10. I know some will do more, but on the whole, on average, the seriously rich that I meet do $10 a point. How are you going to do that? You're not going to do that on day one. You're only going to do that. And here's the rule. It's sort of your budgetary rule of prudence. You're only going to do that when you've got enough profits built up from trading, which allows you to do $10 a point. And I'll give you the business plan for working out how much risk you should take on an individual trade. It's not going to come from capital, ever. It's going to come from profits. If you don't get enough profits to do $10 a point, you're never going to do $10 a point. That's the rule. That's your end destination. Okay, so were you to look, we all have vision boards, don't we? That should be your vision board. By the way, it doesn't have to be Forex or crypto. It can be whatever. But the point is, that's your vision board. Your vision board is, yeah, we want to try and capture the 100 points or the 170 points, and we want to try and do it $10 per point. I'd actually created this for one of my students who said, look, what's the end goal? What's the ambition? And I said, well, this is it. Put that on I think they've got it on their fridge, or I forget which now, fridge or wall in their study at home. That's the end goal. Simple. Okay. And you're not allowed to do it other than through profits that you've made from trading. And you're going to start with a demo account to begin with. That's how risk averse I am. And you might say, you're boring. Can't I just blow my inheritance on $10 a point tomorrow? I'll say, yeah, not with me. Go away. You're wrong. And this is what it looks like. Out of 100 trades, we're going to show you the strategy where you'll never have big losses because there'll be a stop loss in place and losers add to losers. You will never add to a losing trade. Who came up with that rule? I didn't actually. Came from the world's leading traders, like I said, from the book. And that's what taught me. I was a student when that book was written. Okay. When the book was written. Thanks, Graham, for the link. I'm going to look at that after the webinar and then use that in future webinars. Thank you very much. Big losses, none. Now, you're going to get a bunch of small losses and small wins. Why, Alpesh? Can't we just have your crystal ball to see into the future, outfox the market, know where it's going to go and be right 100% of the time? No, I don't know where it's going to go. Are you kidding me? I can take a good estimate, but actually I'm going to ride the coattails of the direction it's already moving in. I'm trend following. Okay, so why small wins and small losses? Because that's what happens. Sometimes Donald Trump does a tweet back in the days when he was president and the whole market changes. So things don't work out. But like I said, about 20% of your trades will be big wins. They will just move into a trend and you'll add to those winning positions. I think one of the better ones we've got on at the moment, see if I can show it. No, I don't know. No. Some of the trends they're not fantastic. Let's just have a look. Sorry, let's have a look. Let's have a look. Royal Shell. Maybe that's one of the, yeah, that's probably one of the better ones we've got on at the moment. Is that going to be a big win? I'm not sure if it's going to be big, but it'll be okay. Might turn out to be small. Nvidia at the moment from $240 to $253 in one day. If you're on yesterday's webinar, you saw this, that we were long on it, and this is how it's transpiring today. So that's the direction it's going in. How does that look to you? It looks all right, doesn't it? Looks all right. Oh, by the way, in terms of will the US end up higher, you're evenly divided, whether it's going to be 41% think yes, 41% think no. Okay, let's look at sterling US dollar. You might not have a view on this, by the way. Let's have a look at that. So that's what's going to happen. You'll get a few of those. And I wish I could get more, but it's out of my hands whether things trend or not. It's out of my hands. I can just be prepared for the success. Whether success comes is an element of luck. And as in life, so in trading. So these are the mnemonics you need to worry about. SELMA. This is what we're going to teach you. Let's talk strategy now, and then we'll talk business plan. Strategy, stop loss, entry, limit order, which means take profit. If we do that at all, if you're a beginner, I'll show you where you take profit. But actually, I want you to get to a stage where you don't take profit. You add to your winners. So you do the opposite. You double down instead of selling out. Amateurs sell out when they should be doubling down on profitable trades. Amateurs also double down on losing trades when they should be selling out. They do the exact opposite of what you should be doing. And if you think about it, that makes sense. Amateurs do the exact opposite of what you should be doing. Otherwise, everybody would be rich if it came just naturally. It wouldn't be a game worth playing. Okay, now I'll explain all that again. Amateurs, when they're in profit, should be doubling down. Instead, they sell out. Professionals do the opposite. They double down in profits instead of selling out. On losses, amateurs double down when they should be selling out. Professionals do the opposite. They sell out on their losses and never double down on them. Got it? I'll come back to it. Trading psychology, easy. We remove that by having a process. Money management, that'll be in the business plan. Additional positions, winners add to winners. I'll show you where in this next slide. There you go. There's a slide. Take a picture of it if you wish. SELMA, that's all trading is. That's all trend following trading is. Number one, volatility-based stop loss. Can you see where I've written one VSL, volatility-based stop loss over there? Okay, that's this yellow line. Our software, what it does for our students, actually trainees in my hedge fund, get it, and then we spun it out for a broader audience. What it does is that stop loss. That stop loss is based on the volatility of the market. The more volatile the market, further away the stop loss. Every successful hedge fund I came across had volatility-based stop losses. I didn't know that. It changed my trading game so significantly, that one thing alone. All of these 5 things are going to change and improve your trading. So first things first, volatility-based stop loss meant the more volatile the market was. See that? Okay, that's volatility, that's noise. You don't want to be stopped out by noise. So you might put that 2 or 3 times the distance of the average it moves up and down over the last 14 periods. So if it moves up and down, say 10 points on average over the last 14 periods, then you might put that, if it moves up and down 10 points, you might move that 25 points away, 27 points away, about 2.75 times the ATR, average true range. You can Google that afterwards, ATR, if you wish, or you'll do it by eye. You might not put it quite there, but you might put it a bit lower. It doesn't matter. It's the principle. I just don't want it to be too close, and I don't want it to be too far that it's meaningless. Okay? Now, Alpesh, if it's a volatility-based stop loss, and the more volatile the market's further away the stop loss, surely that means if it's a more volatile market and the stop loss is further away, you're losing more money. No. Volatility-based position sizing, which again is calculated for trainees in my firm when they're first joiners and are learning how to trade, it's calculated for them. That volatility-based position sizing is fundamentally this. If the stop loss is further away, you trade a smaller trade size, so you don't lose more money. So if the market's more volatile or less volatile, you're never going to lose more or less money. It's a fixed amount. What is that percentage of your capital? We'll come to that in the business plan. But those two things, VSL, VPS, maddeningly important, okay? Number 3, winners add to winners. So you saw where the stop loss was, and when you get an entry, and we'll talk about entries later, that's an entry where the momentum we think is high enough probability. We didn't get it at the bottom of the market. We got it here. Okay, when we get an entry, what we know is we tell the broker we want to buy then. We know where the stop loss will be, obviously, because we've calculated it. And we can also work out where we're going to add to our winning position. So we can tell the broker, even when we do this entry, if and when the price gets to that, and online brokers allow you to do that, then buy more because I'll have some profits in my pocket. So buy another position and put it stop loss at what was the previous entry there. So you'll have 2 positions open, the original and the winner adding to winners. Why? Well, it means why adding to winners is so important. And this, again, I learned from the world's leading traders, because it means your initial position can start small, knowing that if the trend works in your favor, you'll have a bigger position later. Also, if it doesn't work in your favor, then it's only a small position you've lost money on. Genius. And if winners are adding to winners, it means you're risking only profits later on. Now, a lot of times what might happen is it goes up to here, and then instead of continuing further, it might fall back, in which case you've sacrificed what you had, a bird in the hand, for 2 in the bush. So I say to beginners, while you get used to all this, just take profits at this level and have a fixed stop loss. As you become advanced, make that into a trailing stepped stop loss and make that into winners add to winners. Okay, we can talk more about that a bit later on if you wish. 5 is the last thing, and we're going to come to that. How do you know the entry then? Okay, this is probably the most important slide. By the way, can I at the end of this tell you something? So my hedge fund, my asset management company, we launched a venture capital firm in 3 countries earlier this year. I was going to say last year, but it wasn't last year. It was earlier this year, in Switzerland, Germany, and London. We've also spun out this technology, and I want to talk about our plans to IPO that technology. Can I tell you in the last 10 minutes of the webinar? You don't have to listen to that, but the reason I ask for your permission is I don't want people saying, oh, you taught us great content. I love everything you've taught us. Why did you talk about yourself and your own ambitions and all the things you're doing and campaign for 1 million to teach 1 million people and all of this? We hate you now. And sometimes people get really irate, so I ask your permission. Now, this is a slide from Winton Capital. They're based in Hammersmith in West London, okay? They're one of Europe's largest hedge funds. They're headed by Sir David Harding, out of Cambridge University, mathematician. This is one of their slides, and absolute role model of mine. I've never met him, but I think he's an absolute genius. I'm British, okay? And found a way of making endless amounts of money. This is one of their slides. Okay, I've stolen one of their slides. And this is how they explain to investors what they do. And you might think, surely they explain to investors in more complicated language than this. Well, yeah, but this is one of their slides. Trend starts, they didn't get in there. They didn't get in before it starts. They couldn't see the future. They didn't get in at the bottom. They don't have a crystal ball. They had a lag, and then they buy. They're trend following. And they manage billions. Okay, sell there, lag, boom. They manage billions, and that's what we're going to be doing. Who taught me this way of trading? That guy when I was at university, Bill Lipschutz, global head of Forex trading, in the book, published by the FT, Lessons in Trading Strategy from the World's Leading Traders, Mind of a Trader. His chairman at the time was one Warren Buffett at Salomons. Bill was global head of Forex trading, which meant he was the world's largest Forex trader at the time, because Salomons were the biggest bank in Forex trading at the time. They had an unlimited line of credit. So it's ridiculously large sums that we were trading, and he taught me this. And 2 things that he taught me. One was the business plan, and secondly the entry. So we're going to start with the business plan first. Is any of this worth it? Is any of this worth it? Is the pot there? Okay. By the way, most of you don't know what's going to happen with US dollar, and that's perfectly fine. It doesn't matter. Okay, let's just have a look at risk capital. We'll do that. So here we go with this, the road to rich, as it were. Okay, business plan. Is it all worth it? That's the first thing we need to know. That's my mum, by the way. As you will know, if you watch my webinars, she always appears in my webinars. It's my mum, with now King Charles. Is it worth it? All right. Well, trading is a bit like driving, and driving is well worth it. But it's a bit complicated. Rear view mirror, steering wheel, clutch, accelerator, brake, and all the rest of it. And you learned to do all of that, didn't you? Well, same with trading. What is trading? It is stop loss, entry, limit order. It's SELMA. It's still various things we've got to learn, and we've got to learn the skills to do them. Sterling yen? Yeah, sterling yen. Okay. We've got to learn the skills to do them. Where do we put the stop loss? When do we enter? When do we know where to add to our position, or just take profit? That's perfectly fine as well. You won't make as much as somebody who adds to their winners, but your life will be simpler. Okay, so there's a trade-off with simplicity, and you wait all day, or well, 15 minutes a day. You scan these until you get one good trend on those. Could be Google. By the way, this is Alphabet at the moment, and we've had that one didn't come to March, but the next one after it's worked out all right. Thanks very much. As of yesterday evening, and you can see with these 5 arrows here, they're just measures. They're just a little indicator for me of where things are. So if I scan a chart quickly, I can see, oh, okay, it's all green. It still looks the trend's strong. So even if it's falling a bit here, I might say to myself, well, I'll just keep waiting. I'll give it a bit more time. So it just gives me a good, or rather gives my traders a good time. I don't spend much time sitting in front of a computer anymore. I'm fat enough. I've got people to do it. NVIDIA. That's been a good one recently. So some of the tech's coming back. Will it last? I don't know, because we're trading, so it doesn't really matter. That was yesterday, and we're still in it. And those bars are 15-minute. So do you see how you can have a day job and still trade? That's 15-minute bars. Each one of these is a 15-minute bar. The price has gone from 250 to 250. Sorry, 240 to 253. That's a $13 rise, or 1,300 points. 1,300 points in one day. Okay, and we're not out of it, and that's just 15-minute bars. So you can have a day job. You don't have to be sat in front of a computer, and if you're not sat in front of a computer, I'm happy, because otherwise you'll revenge trade, or you'll trade out of boredom, or you'll second guess yourself and you'll mess it up. And those are the most popular reasons why people screw it up. So trading's like driving. Okay, so Bill Lipschitz said to me, he said, look, if it's like driving, okay, let's first make sure if it's worth it. So we're going to put a business plan together. And I was a student at the time, remember? So when I first met him for the book, because as a student, I was training to be a barrister, and I really enjoyed trading. So I thought I better meet the world's leading traders if I want to full-time trade. And here I am now, 26 years later, still doing it. So that's probably something of my credentials. And he taught me, and so did David Kite within that, and Bernard Opperty, who runs a $2 billion hedge fund. And I learned stuff from other people who are not even in the book, like Kaveh Alamutai, who was the UK's largest paid employee at the time. And he's not in the book because his employer at the bank, Tokai Bank, and subsequently he moved to More Capital, wouldn't let him be. By pure coincidence, I ended up living directly opposite Kaveh on Hamilton Terrace in St. John's. Pure coincidence. But my point is, these were the teachers that taught me what I'm telling you. And without them, I wouldn't have learned. I wouldn't have known. And I published it in a book because it's a bloody good place to publish stuff. Max loss, 1% of total capital. That's what he said initially. Now, Bill said to me, look, Alpesh, you don't have any capital. I was a student. I didn't have any money. He says, you don't have any capital, but you need to work out a business plan on whether or not you should trade based on, well, what about if and when you get capital? Okay, because obviously if you've got no capital, you shouldn't trade at all. So that can't be the right answer. The answer is, well, what if you get some capital? Eventually, not on day one. Eventually, you might start with a demo account. Then you get to friends and family and they say, God, you're so good at this with your demo account. Yeah, we'll give you a bit of money, which is what happened to me. So total capital, £20,000. Not because that's what you start with, but that's what you'll eventually get to. Might be in a year, might be 2 years, might be 3. Depend on your personal circumstances. Okay, maximum loss per trade, therefore, would be 1% of 20,000, which would be £200. Let's assume you're a bit better than a coin. Not much, a little bit. So you get 60 out of 100 winning trades. We're going to tone all these numbers down in a minute, so don't worry. They're all over optimistic for now. So your average loss is £200. This is what Bill took me through as a student to determine whether or not I trade, to show me what was worth it. Average loss is £200. Okay. By the way, the majority of you said you've got about $2,000, right? Or the vast majority under $5,000. You know, when new people start in my firm, we give them $1,000 of my own money to start learning to trade. Why just $1,000? Why not more? Well, first of all, A, it's my money. B, I can't give them client money. The regulator would shoot me because they're not trained, obviously. So it's got to be my money. And if it's my money, I'm not giving them more than that. They can start learning all of this with just $1,000. So even with $2,000, you're fine. You're fine to learn because you're actually going to start with a demo account and you don't need any money for that. Anyway, average loss, £200 would be based on that. The average win, well, remember, winners add to winners. We're going to pick a strategy where we make more when we win than we lose if we lose. And don't forget what we've done with all of these trades. Let's just go back to the S&P 500, for instance. What we've done with all these is, look, it's just crossed. I got a WhatsApp from my assistant. It's just crossed the, actually did it a lot earlier, but it's just done it again, the adding to winner position. So we add to that winning position. And don't forget, only when this price moves to this dotted line do we move the stop loss there. That's called a trailing stepped, not dynamic, stepped stop loss. And that gives a bit more room for this to go up there, pull back, go back up, rather than getting stopped out if we had a dynamic. So stepped, write that down. They're marginally better as a stop loss and making sure you don't get whipsawed out. Okay? Some brokers offer them, and we'll pick those. Now, we'll come back to those. Okay, so average win, we make more when we win than we lose. So Bill said to me, let's imagine you do 100 trades. I said, okay, let's imagine I do 100 trades. So I'm going through this and we're doing 100 trades, and just going to put another question up there. And I said, well, wait a minute, that would mean I've got 60 trades at £300 profit for each trade on average. That's profits of £18,000. I told him I was so excited. I said, tell my parents I want to leave university. All I want to do is trade. Sit in front of a computer in my underpants, eating nachos all day long. I'll be living the dream. I'll leave university. And Bill slapped me and said, what a minute, what about the 40 losing trades? I said, yeah, but I'm still making a net profit of £10,000 per 100 trades on that. That's more money than I've ever seen. Tell them I'm leaving university. This is what I want to do for the rest of my life. And he said, calm down, calm down. You're not thinking this through. I said, yes, I am. And then I did this calculation. I'll be a day trader. I'll do 100 trades per week, 50 weeks a year. I'll do 5,000 trades per annum. I'll make $500,000 a year. Look at me based on that math. $500,000 a year. I know what you're thinking, and you should be. Don't be stupid, Alpesh. We're not going to do 90% of that. We're not going to do 2/3, a half, a third, or even a quarter or a fifth of that. We're not even going to do 15% of that. And you're right, you're not. Let's tone it down. Imagine you just did 10% of that, just for a second, and you're not. We're going to tone it down even more. 10% of that. I said to Bill, okay, I'll do 10%. Still 50 grand. I'm over the moon. He said, you're not going to do 10% of that, Alpesh. There is no magical, I'll do 100 trades per week. Just keep banging the keyboard and more money will flow into my bank account as if by magic. Yes, you can have a dream about that tonight. Ain't going to happen. He said, what you're going to do, Alpesh, instead is to be risk averse and sensible. You're going to keep your day job. So you've got another source of income. You're going to have 100 trades every 6 months. So you're not reliant on your trading initially while you're learning to feed the kid. And I didn't have a child at university, but you know what I mean. And pay the rent and put food in your stomach. You're going to do 100 trades per 6 months. That's about one a working day, which is what I showed you earlier. That's our business plan. Okay, 200 trades per annum, which is £20,000 per annum. So it's not 10% of our business plan. What if we did 4% of our business plan, which is £20,000 per annum based on those numbers? Nope, we've toned it right down. We've said we're not going to do 10%, we're going to do 4% of the business plan. Even that's too optimistic. Remember what I told you earlier, our target is 500 per month, 500 per month. Why? Why such a risk-averse approach? Why keep the day job? Why not just start trading? I'm talking to the world's largest trader at the time. Why did he just not say, given that he's doing it, hey, do what I'm doing, just leave your job and leave some studies and just trade. Yeah, you'll be great. Risk aversion. How stupid would that be? Why would you not start off with continuing a day job, learning, seeing if it's for you, and then tone down the business plan, say, you know, you're not going to achieve that business plan, sunshine. You're not going to achieve even 4% of that. You're going to achieve about 1.8% of that. Is it then worth it to make that 500 a month? Yeah, and you're not going to make 500 a month because it's not guaranteed. Some months you'll make more. You'll keep that for the months in which you make less. Now, to some extent, did that destroy my hopes and dreams? Well, I wish he would have told me, here's a secret formula on a piece of paper, and now you're going to be rich. Of course, that's what I wish he told me. He didn't. Sadly, he told me the reality. And then when I thought about it, I thought, well, yeah, of course it's going to be, it's not going to be easy. It's going to be hard work, but it's going to be worth it. And it has been. So why do people fail then? Because I did ask him, I said, well, wait a minute, if these numbers are true and I can make those numbers, 500 per month, how come everybody isn't rich? You should be asking me that. He asked me that. And he said, well, bad teachers, bad mentors, and bad strategies. And I said, okay. By the way, I noticed that most of you are doing spread bets and CFDs. That's perfectly fine. Options, some of you can apply momentum trading to options trading, so that's perfectly fine as well. No issues there either. Okay, so let's talk then about the final part of the webinar, which is strategies, and then we'll do the Q&A and brokers. Okay, and let's do one more poll because I want to share the data with everybody. So bad mentors, bad teachers, bad strategies. So let's focus on entry strategy. That's my mum again. Okay, so that's what we're after. No, we're not. We're not after 20,000 a year. No, wrong. Remember what I said, 500 per month is our goal. And it's not guaranteed by any means. Some months you make more, you keep that for the months in which you make less. And so you average out at that. And if you can't average out at that on a demo account, then guess what? You're not going live. That way, I am sure, and I look over your shoulder, and I'm sure that way you're not going to damage your capital. I know, risk averse. Okay, and this is the trading we're doing. We are going to be that guy. See that guy at the end on the coattails? That's us. Imagine this is the market, this guy in purple or Goldman Sachs or whatever. We are not trying to step in front of him and work out which direction is he going in, because we don't have the firepower, the computing power. I don't have it in my fund. I do not have the ability, the computing power, a black box, which tells me, and leave it alone, which direction things are going to go in. Equally, Bill does momentum trading. Bernard Opity does it. A whole bunch of us do momentum trading. Winton Capital, as I said, AHL, as I said, Brevin Howard, as I haven't said so far, do Aspect Capital, do all the biggest hedge funds in the world, do momentum trading. Renaissance Capital, to some extent, they've got other strategies as well, but they do that. Some front run. We're not going to do other complicated. Some do arbitrage. We're not going to do that either. Okay, so that's momentum trading. So if that's momentum trading, how do we do that? And Bill said that's the easiest thing for a retail client to do. It just so happens it's what professionals, a lot of them do as well. David Kite did momentum trading in the Kite group. He's in the UK rich list now. And what Bill said to me is this. I'm going to give you the entry strategy now. It's no skin off my nose sharing that with you. Okay, so make good notes of this. Bill said to me, look, Alpesh, you're a poor student. You're not going to hire lots of analysts to do this. You're not going to outsmart the market or anything like that because you don't have the firepower or the resources. So you're going to have to look at what's already available, and it'll be good enough for you, Alpesh. It'll be good enough. You'll make a good living. And I said, okay, let's look at it. Right? And he said, what we're going to do is we're going to measure how close to the high the price closes in every given period. That gives us an increased probability the price is going to move up in the next period. Not a guarantee, but an increased probability. He said there's many ways of measuring momentum. One could be higher lows, one could be higher highs, one could be is the price closing near the high. It's not guaranteed it will continue moving higher. I said, well, if it's not guaranteed, why the hell am I doing it? He said, what you're going to do is, and I'm a poor student, so he said, what you're going to have to do is still apply the three things all hedge funds use to improve your chances of being right, of the trend having started and continuing. One, you're going to use multiple indicators, such as, is it making higher lows? Is it making higher highs? Is it closing near the high? You're going to use multiple indicators to measure that, not just one. So what you're going to do is you're not just going to say, oh, it's moving, the close is near the high, I'll leave it. No, you need multiple confirmation. Corroborative evidence. Is it also making higher highs and higher lows? So you need corroborative evidence from multiple indicators. He goes, that's what hedge funds do. They don't necessarily look at the same things I'm looking at, but they look for multiple corroboration of a trend having started. They might be looking for all sorts of incredibly sophisticated AI analysis of deep data. I don't know. We're going to have to keep it simple because I didn't have the money to do it any more complicated. So the next thing you're going to do is you're going to say, not just in the time frame you're trading, which might be the 15-minute or 30-minute, but the next time frame, you're going to see if the same is true in that. Are multiple indicators also showing the same direction, so multiple timeframes. And the third thing, and probably he said the most critical, is PC. And by the way, when we look at all of this here, these are live trades now and where we are on them. So let's look at JP Morgan, which you saw yesterday. We were short and it fell lower. I think it was around here yesterday when we were doing the webinar, and it dropped a bit more. It's come off a little bit since then, but it's still short position for us. When we first got in there, when that was down arrow was generated, it was that the prices had started moving, closing near their lows, new lows, and so on. Okay, so we get the computer to scan all of this data for us on multiple time frames to find where that's happening. Doesn't guarantee it's going to move in a certain direction. Doesn't guarantee, there's no guarantees. I'll come to PC in a second. So I said, well, how am I going to do this? What, with a microscope? And he said, no. What you'll do is you use tools which are already out there, which do not work accurately enough. So I said, well, if they don't work accurately enough, how the hell and why the hell am I using them? He said, what you're going to do is you're going to use them slightly differently. You're going to amend them. Okay, so it's a bit like getting a car, I don't know, getting a Kia and supercharging it with nitrogen. Okay, what you're going to do is you're going to take the indicators which are out there, but you're not going to use them the way the textbooks do. You're going to see, are they flat to just starting to rise? Notice that bit where it's flat, starting to rise. He said that'll avoid lagging indicators being too slow because you're taking them at an earlier point, and it'll avoid, because you're filtering, premature indicators like the stochastic being too premature because you're going to filter. So they all need to, the MACD stochastic, both need to, in both timeframes, be flat to rising. And PC was price confirmation. You need a 2-period high, whether it's 15-minute or 1 hour, whatever time frame you're doing. And that needs to be across both time frames. Okay, that meant that you had like a wave coming in the shorter time frame and a wave in the longer time frame in the same direction. That allowed for the possibility, but not the guarantee, of a bigger trend. You know why sometimes when you buy into something and it just changes direction on you? That's because you didn't look at the longer term time frame where the wave was moving in the opposite direction and it superseded it. So multiple indicators, multiple time frames, flat to rising, and a 2-period price confirmation. Those were critical factors. That was the entry strategy. We could use the reverse of that in the exit, or, which is what the X cross is, or you could just simply say, we'll use a trailing step stop loss to make life easier. There's always simplicities you can use to make everybody's life easier, but there's always a cost to simplicity. That's NVIDIA. Now, that's pretty much the highest it's been since we started the webinar. The entry came in here. Now, notice how when the entry came in, we still, guess what? It came in, still went flat for a bit, then moved down. Any good trading strategy shouldn't be the type where you've got to be in front of the computer screen and, oh, 1 second's gone. Sorry, you missed it. Should be the type where you've got ages, you've got hours in which to enter because the price is near there. Now, sometimes if you're not lucky, nothing will happen. It'll just, right? Because it's out of your hands. What this is, all this is saying is the setup is right, that should the market get somebody throwing a match into it, this stock's going to blow to the upside. That's all it is. If nobody ever throws a match into it, nobody sees the trend you're seeing at Goldman Sachs, then nobody hits the buy button and this doesn't go up or similarly fall if it was a short. Okay, it's just that the conditions are right. Now, I want you to understand this. We are not forecasting the future because the future is unknown and we don't have a crystal ball. All we're saying is the conditions are right. It's like spilling petrol on the ground and somebody going, do you know what? That could blow up. They're not forecasting the future. What they're saying is there's a high probability that could blow up if somebody throws a match there. That's all they're saying. It's not that I can see the future and say, oh, that oil's fallen, therefore I am guaranteed it's going to go up. There's a subtle difference which private investors often don't realize. They think people like me are somehow super clever, can see in the future. We can't. We can just see a setup which might give an opportunity if we're lucky. The number of times people will say, oh, my fortune is down to luck. That's what they mean. I was in a position to capitalize, but actually I was lucky that the market blew up to the upside. I was lucky when, what's her name? Liz Truss. I was lucky because she collapsed the pound, which gave us, if you watch my LinkedIn last year, you would have seen, gave us a fortune. Thank you, Liz. We didn't do the short trade, by the way, as I put on LinkedIn. We only did the long trade and started buying pounds. We didn't do the short trade because I did not want to profit from falling sterling being British. I know it sounds stupid, but and I put that on LinkedIn live as it was happening. We are not doing this trade. And then when it went long, when we felt it had bottomed down, we didn't get in at the bottom. We got in at 110, which is way off the bottom. We said, right, now we're buying. So that was the difference. And if my investors didn't like it, they could go do one. Anyway, that's a talk I gave at Bloomberg. That's what we found were the people who attended. And I was surprised. I was shocked. I would not have expected side gig entrepreneurs, yeah, and that was before side gigs were a thing. Retirees, well, I was a bit surprised retirees, but I guess they've got time. Plumbers, mums, that surprised me. Students didn't surprise me. School teachers surprised me a bit, but that's what surprised me in terms of backgrounds. And I loved it that you had so many different backgrounds. I perfected this when I was at university, so I was a student myself. I used it to win competitions in various places, including Bloomberg, Channel 4, and the Financial Times. That's them putting me on the front cover. They then said, would you like to write some books on this because you seem to know what you're talking about? And I said, hell yeah, that'll help raise my profile. Because then I got greedy when I won the competition. I thought, why don't I raise my profile to raise capital and set up as a hedge fund? Seems good. I mean, with my own capital, I would have made 1. With other people's capital plus my own, I could make 100. And trust me, it was 100 to 1 differential between other people's money and mine, only because I didn't have a silver spoon in my mouth. So that's me winning it there. Okay, I then set up the firm. That's me at the first set of offices when I had hair. It's not trading, that's maybe lose hair. Some of the people who licensed the software and the know-how included Merrill Lynch, HSBC. They had a JV together. That's me on their front cover. They and a few others like American Express basically paid me about $1 million over a number of years, which helped me raise capital to put the money into the fund. That's what capitalized it initially. You're not all going to become hedge fund managers, obviously, because you're going to think, wow, I don't want to go through all of that. And writing in the FT helped raise the profile to capitalize on it. I've been teaching ever since, and I continue to do so. Time frame, 1 hour. Like Warren Buffett, keeps teaching, writes books, because it helps keep you sane for a start. This is what we found was the most lucrative time frame, the 1 hour time frame. Now, I gave my team different time frames to trade, and we looked at the data and we analyzed it. And what we found is the 1 hour time frame is the lucrative. The number of trades in a month were roughly about 25. Okay, now that's about 1 a day roughly. Some months you could do 40 because there were just so many good signals. Other months, typically August, 16. Okay, as low as 16. So there's a big variance there. Net pips captured, 2,250. That means winning minus losing. Winning minus losing. Okay, some months you might get 4,000. I think this month is going. I think March is turning out to be rather good, just because, well, you've seen what's happened with Silicon Valley Bank, and it's just led to all this volatility. You've seen it with some of the trades here. Other months you might end up with 0. Okay, over there. Best winning streak, 70 out of 100. Worst, 30 out of 100. Let's say your typical max loss is 50 points. If you did $2 a point and don't, anybody who tells you to do £1 a point usually have got a kickback relationship with a broker that they want you to use. So they're frauding you. Okay, it's as simple as that. We're not even going to start off with £1 or even $2, but I'm going to show you this as an example. If you did $2 a point, that would mean you'd be losing $100 on a trade. You don't want to lose $100 when you're learning something, do you? No. Okay, but you would make $2 times 2,250 net pips. You'd make 4,500 in a month. Not guaranteed. Some months it might be more. Some months it might be nothing. Okay, averages out. Hang on. I said we want to be making 500, not 4,500. That's right, 10% of that. So you don't need to do $2 or £1 or whatever. You can do 20 cents to get to that target. That's when we knew we had the Google of trading. Google is an algorithm which looks at data. Well, this is an algorithm which looks at data on prices moving. We knew we had the Google of trading because retail people could do it, because then they're risking $10, not 100. And that I like. That's fine. Actually, they're going to risk nothing because we're going to start with a demo account. Demo account. So then a friend of mine who I saw last night, and I'll be seeing him tomorrow evening as well, from Barclays Bank, said, why don't you teach me? I said, no, why would I teach you? Why do I want to teach anybody any of this? I'm busy raising capital for my fund, and we're launching a private equity fund and blah, blah, blah. And he said, no. Why don't you spin this out as a tech company? Jeff Bezos, could just copy the billionaires. Jeff Bezos is a billionaire, was a hedge fund manager at D.E. Shaw, and then set up Amazon. Set up and he said, and mentor me. Donald Trump's on The Apprentice. He's a billionaire, and he has students. And Lord Sugar's a billionaire, and he does that. So he sort of got me at the. And he said, we'll float it at Barclays. So I went into an agreement with him. I said, okay, if I create the software, spin it out, we'll invest initial seed capital. will you guys IPO it if we hit certain targets? And he said, yeah. So first thing we want to do is get about 1,000 to 2,000 people using it so that we can get a valuation of about 30 million from venture capital on it. We've seeded it up to now with our own fund. So I said, well, I want it to be self-paced. I want it to be one-to-one attention. I don't want subscriptions. I don't want anybody paying anything every day, every week, every month. I want them all upgrades for theirs for life. I want it to be compatible with their work. I don't want any hotel costs, no travel costs for them. I want them to live trade. I want to be able to look at what they're doing because it's my reputation on the line. So I need them to get to profitability. So it's got to be limited to people who are going to be looking at it and who are going to let me look over their shoulder at what trades are placing, and I can say, yeah, that's good, that's right, no, or that's wrong. And I say, I don't want to do all this crap that others do because I don't want to be tarred by their poor reputations. And there's a whole bunch of people out there who have such terrible reputation, and they keep getting criticisms of them. Who was recently, there was somebody emailed me about yet again, Greg Secker, yet again. I got an email saying he's awful, so what can I say? And that's what happened. So we created this Project pipspredator. Buy when the price goes above the horizontal line because that confirms this price momentum. Odds of a move have increased. Biku at Barclays, Biku Alawalia, created that name. He came up with the whole idea of the software, spin it out. He said, your hedge fund invests in other companies. Why don't you create your own investment? You get 100% of it. And I thought, I actually quite like that because tech companies go for billions. I want to IPO this one day, maybe in 5 years for $1 billion. I think I want to get VC investment in 2 years at about 30 million valuation. And we've already spoken to Google Ventures because they get data and information. I was about to say, Anne had a meeting with Silicon Valley Bank last year. You can see it's a complicated industry we live in. And actually, I'm at Silicon Valley Bank next week as well. Well, HSBC now. Can it make money? Yeah, I'll show you some more trades. Is it easy? Well, you've seen the rules. Okay, I've given you the manual rules. Multiple indicators. That's key. Not the way the textbooks use them. That's key. Somebody once said, but these indicators don't work like MACD and stochastic. I said, I know. That's why we're not using them. We're using multiple indicators across multiple timeframes, not the way the textbooks do, because we don't have the firepower to invent something completely from scratch. What we've done is amalgamated what's already out there. Price confirmation. We also do a bit of pattern recognition in there, but that's fine. We do that. Winners add to winners, losers add to losers. Volatility-based stop loss, volatility-based position sizing. And you can do it with a day job because we'll give you the same manual that we use as well. That's how we did it. Simple checklist rules. If you want to learn about it, we also give you a whole program of education created by me for my staff within the hedge fund when we hire new people. But you don't have to do that. You can just use the manual and the software. But you don't have to even do that. You can just do it manually, as I've shown you already. Okay, most of you on this are in Forex, some of you are in stocks, some in indices and commodities. Well, guess what? The good news is all of that's covered, isn't it? Because anything that moves with the price is covered, right? Let's look at Microsoft. That's where we are on Microsoft. Now, we already had a long position on that, on long trade from 2 days ago. This is the 15-minute bar. Then that got confirmed. Okay, that's the 16-minute bar. Okay. Thank you, Graham. You've worked out it was my wife's birthday yesterday. Thanks. You've seen my LinkedIn or my Instagram where I mentioned it. Right, there we go. All right, and you've got it there. Now, so stocks is fine, but what I'm saying is please don't be obsessed with stocks. We are not placing those trades based on anything to do with the tech industry. We're doing it on trends. That could have been the price of hot dogs at your local Greg's. Okay, it doesn't matter what the product is. Sometimes I get people so obsessed with just stocks. Now, this isn't mine. These are some of Biku's early trades, and he did not have $30. He wasn't that rich, even though he worked at Barclays Bank. What he did instead was built that up with the profits from the initial stock. Because I said, if we're going to do it before we launch, I want you to use it. You're the bloody guinea pig. It's your idea. You're the guinea pig. He's now left Barclays and lives in Dubai, but he's in London this week because it was his mum's birthday yesterday as well as my wife's. His mum is not my wife, by the way. 75 times $30, 2,250. It's another earlier one of mine. Now, one thing he didn't listen to me on was trading very short time frames. I said, I really want you to do 30-minute and 1 hour, but anyway, 15 minutes is fine. Also, the currency pairs I love the most are major versus minor currencies and minor versus minor. The trends tend to be smoother. Biku doesn't often listen to me. He did major versus major, which is fine, but they're a bit more volatile. The 4 major currency pairs are euro, dollar, yen, and sterling. So I like major versus minor or minor versus minor. I don't like major versus major. I also like the DAX. And right now, take a picture of that. Those are the ones we're watching the next signal on. These are trending nicely at the moment in the timeframes given. So NVIDIA 15-minute bars, for instance, trending nicely at the moment. Things will slow down as the US gets ready to close. Actually, in the final hour, it'll probably go bloody nuts. Okay. Now, when I said you need industry experts to review, gets to the heart of the matter of trading by clearly elucidating the methodologies of successful trading strategies. Successful trading strategies. That's Pat Arbor, chairman of the Chicago Board of Trade, the world's largest exchange. It's in print. It can be proven because it's in the jacket cover of the book published by the FT. So everything has to be copied, verified, audited, all these reviews and so on. My point being, that has to be the standard and the benchmark when you review something. It can't be Mr. KL from Nowhere Land, who's probably an actor. Okay. And we've got a load of those. Without an indicator, this is what trading is like for most people. What they're doing without such a signal generating indicator is what they're doing is they're plowing through each thing manually. And in the old days, when I was just an ordinary amateur, I'd do it manually. And you're welcome to do it manually. I've given you the rules. Okay, so that came about because there was a 2-period low, multiple indicators, multiple time frames were flat to falling. So we were able to go short. And you can do that. You can do that manually. You can work out your volatility-based stop loss. And on the flip side, where you're going to add to the winner. Okay, no great shakes about it. Or you might create an entirely different system of your own where you're going to, and reinvent the wheel if you wish, where you're going to find trends. With an indicator, this is what it's like. I get to see a lot more opportunities, a lot more quickly. So we divide it in our staff teams into different categories of who's going to look at major currencies versus minor currencies, minor commodities, oil, etc., etc., etc. My ambition is, as I've said many times before, is to IPO this technology thanks to Barclays, or whoever it might be HSBC now, thanks to what's happened with Silicon Valley Bank, to IPO this. To do that, we want to get to a venture capital stage where we get to about a valuation of 30 million, which we estimate we can do on our financials. When we get to about 1,000 to 1,500, I don't know, maybe a worst case 2,000 people using it, proven case studies of profitability. They're not all going to be profitable.